Good evening, ladies and gentlemen, and welcome to the Property Tutors Finance and Market Update webinar. Thanks so much for turning up on time. Hope I started on time. Oh, 7:31. Somebody will probably send me an email about that. You can guarantee it. But hey, great to have you guys on board. I've got Mr. Dave Windler waiting in the wings to have a chat to us as well. But before I bowl through to that, my name is Steve Goodey. I'm your host this evening. Apparently, I'm a property investment expert. It says so right there on the slide. So I'm going to roll with that. I've been a property investor for 20 plus something years, and I've been coaching property investors for, coming up on 10 years now, I think. I really enjoy doing these webinars. They're always live, they're always fresh, they're always great content. I get a kick out of doing them. One of the things that I really enjoy about this is how interactive it can be. So if you have a look at the slide that's on now, you'll see that there's a webinar control panel on the right-hand side probably of your screen with the GoToWebinar software. And what it allows you to do is put in questions. And you can ask the panel here today any questions you want to ask, and I can answer them or ask them of Dave. So to show that you've figured that out and got control of it, why don't you type in what town you're logging in from this evening, and it will let me know that there's people online, we're being listened to, there's people saying g'day. Yeah, there we go. So that's working. So Auckland, Hamilton, Kapiti, Tauranga, Palmerston, North Wanganui, Wellington, Chicha, Zimbabwe. Yeah, nice one. Hamilton, Brooklyn, Wellington, Hamilton, Bulcott. Yeah, excellent. Everybody's online. That's looking really great. So the way we run these webinars essentially is I've got a market-leading expert online with me to give a short presentation and basically give you an idea of what's going on in the finance market for New Zealand properties. And what I really like is when you guys have a burning question, ask the question using the software here, and I will do my best to either answer it or get Dave to answer it or cover it at some stage during the presentation, which kind of makes me kind of busy in the background here, but it gives Dave a chance to have a bit of a conversation with you guys and talk through a lot of the freshest sort of questions and queries that you might have. So yeah, let's roll with that. So you've obviously got your head around that. That's working really well. Excellent. The other thing I'd like to mention too, just while I have you all available, is that I'm doing another webinar on the 4th of October at 7:30. And what I thought I would do is Property Tutors Facebook fan page and our database has an awful lot of, I suppose you'd call it fresh blood or new people in there. And there's an awful lot of people also who are really interested in property investment and want to upskill themselves a little bit. So what I was going to do on the 4th of October is go and do another one of these webinars, a free online seminar, and roll it back a little bit and go, let's do Property 101. Let's explain why property investment is a great deal. Let's explain the 3 biggest traps that most investors tend to fall into in their first property deal or 2. Let's roll through some of the terminology like leverage and yield and return on investment and how to figure those out, do a little bit of maths there and help you figure out what a good deal actually looks like. And also explain things like the difference between being a property investor and owning a property business. And then just cover some of the real entry-level stuff like fundamental strategies in property investment and how they work and how they roll long-term as well. And then lastly, look at, in the marketplace that we're currently in, what's actually physically working right now. Now, if you would like to get involved in that, see that I've just a few minutes ago posted the registration page on the Property Tutors Facebook fan page. So if you guys online this evening would like to get stuck into that, register for that free online seminar as well, please just go from the webinar software you're in now straight across to Facebook, jump onto the Property Tutors Facebook fan page. If you're not a fan of it already, like it, and if you are, great, awesome, and what you'll see is one of the first things on that page is that webinar. You can click in and register that now or do it, in fact, after this webinar if you like as well. Now, it might not be your exact cup of tea, but I imagine that you know a whole pile of people who are interested in property investment and this may be of use to you. So what I would ask is I put on these free webinars and try and give you guys the best and most current information I possibly can, and I do it absolutely, totally, and completely for free because I just love you guys so much. And so what I would say is, as a thank you to me, I would really like it if you guys jump down there to the bottom of the page, hit share, and shared it on your wall. Just show people, hey, look, here's somewhere they can go for some free, relevant, decent information to get them started in property investment as well. Okay. So that's that. Let's get back to so that's our Property 101 seminar. As I said, 4th of October, 7:30, another free seminar. Can feel free to jump on there. Would love you guys to, as I say, share it and, get stuck in there as well. So who are Property Tutors? Well, heck, this is our office, our main office now in Wellington. This is in the Hutt Road, one of our company vehicles in front of it. We are a property investment coaching company. We advocate cash flow positive buy and hold investments, which is the property investment side of Property Tutors, if you like. The way that we get there is predominantly we trade in property. And what we do is we coach and help and assist our clients in buying houses, renovating them, and selling them for a profit until they have the equity and the cash flow available within their portfolios to be able to go out and buy hold properties, which are properties that you're going to sit on for 10 plus years. We also do a lot of other types of property investments, apartments, new builds, developments, boarding houses, that type of thing. But in essence, what we do is we help our clients make themselves money. We don't buy properties with our clients. We tell them what to buy and how much to pay for it, what the renovation should cost, and help them make the best profits that they possibly can out of those properties. Now, we also don't take a clip of that ticket. We also don't sell properties to our clients because we are in fact not real estate agents in any way, means or form. So that's kind of a rough idea of who Property Tutors are for anybody that's absolutely brand spanking new on the webinar with me tonight. Now, the other thing we do is a lot of these webinars, and I've done maybe 4 or 5 of these webinars per year for the last 5 or 6 years. And at the extent of starting to repeat on myself, I nearly always do some sort of market update and pitch an idea where I see the market sitting right now. And I don't mean to brag, but I get this stuff right quite often, simply for the fact that I do about 17 or 1800 open homes every year. I speak to every single solitary real estate agent in my target area at least every couple of weeks. I'm on the ground and I help my clients buy 200 or 300 houses a year. And so I'm kind of right at the coalface there, if you know what I mean. I see a lot of action in the real estate market, and an awful lot of the time I get asked to sort of gaze in the crystal ball and figure out, hey Steve, what's going to happen in the next few months or the next couple of years? Now the next few months is really easy. Even the next 12 months is quite easy. The next couple of years gets a bit random, and I'm not going to put my hand on heart and say I know what's going to go on. But what I would like to say is what happened in the marketplace the last time we had a really big boom in values. And let's talk about Auckland just for a little while, because love it or hate it, Auckland does absolutely dominate the property market in New Zealand. What starts or what happens and what's going on in Auckland dominates the rest of the property market in New Zealand. We have buying rules that we have to abide by, which are sitting there predominantly to placate and please the Auckland market. The Reserve Bank does things like the loan-to-value ratio restrictions, essentially, simply to cool off the Auckland property market. So what was going on the last time we had a really decent boom, sort of 8, 9, 10 or so years ago? Hey, we'd just won the America's Cup. Okay, that had just happened. A lot of people were coming in and investing in Auckland because they needed commercial space and accommodation, and they were looking at Auckland as a boom city because we'd just won the America's Cup. The other thing that was happening around about then is we were about to have an election, we were about to have a new government, and then finally the last thing was it was spring and it was about to come into summer, and we were going to get stuck into some half-decent weather, and we were going to come out of this winter property listing low number doldrums that we normally have. But what do we have now that's different to that? Well, we've just won the America's Cup, we're about to have an election, and it's spring coming into summer very shortly, sure, but one of the few things that we have now that we didn't have then is historically low interest rates. You can borrow money at 4.5%, no problem, let's go. Immigration, sitting at around 100,000 people a year. Back then, 8, 9, 10 years ago, it was really close to about 30,000 people a year. So it's masses of more immigration. Believe it or not, I know we've had Hurricane Irma go through the States, and we've got terrorism threats all around the world, and we've got all sorts of interesting things on. But if you historically look at what's going on in the world, we've also got an incredible and prolonged period of actual political stability. And I say that even leading up to an election, which is starting to look like it's going to get really interesting, right? The other thing that we've got is an environment where it's actually very, very hard to build a house. I know that there's thousands of houses being built right now, but there's not enough thousands of houses being built to soak up the required numbers that we need to keep the country happy. We're still rebuilding Christchurch. There's masses of commercial development and tower cranes and building going on in Auckland. There's even some going on in Wellington, and we're still not doing enough. We still don't have enough building materials, expertise, builders, labourers, designers, engineers. We still don't have enough stuff to build the number of properties that we actually need right now at the moment. So I'm looking at this and I'm going, is this another perfect storm? And I got to say, the Auckland market is a little bit dead at the moment. Average number of sales are well down, average values are well down, and the smart property investors are going into that Auckland market and going, it's never going to be any cheaper than it is right now. It's an interesting look when you think about it, but they're not wrong. You can't have that many people come into New Zealand and, you know, need somewhere to live and need somewhere to be, and we don't have that. We just don't have enough houses. So the country's building as many houses as they possibly can. We've got older places being knocked down. I think the net increase in houses just does not cover the number of people that we have and the number of people that are moving into this country. And I don't see that fixing very quickly. So I think that the election is over with. In a few weeks' time, we settle down into either a red or a blue government. It becomes summer and everybody suddenly decides to put their property on the market, as happens. And people are going to look at both the Wellington and the Auckland market and go, you know what? Houses are quite cheap at the moment, and it's not impossible to get finance. So let's go. And that's my prediction. That's where I see it sitting. Feel free to type into the comments section there if you massively disagree with me or you've got another perspective on it. But I think that's where it sits. And that brings us to this very happy, cheesy-looking individual that we have on the screen here this evening, Mr. David Windler. Look at you go.
It's a sort of photo only a mother could love, isn't
it? That is pretty fantastic. We were talking about this off air and going, I love to give you the old Kiwi dig, but it's really hard to give you grief about this. That's actually really big award, isn't it?
Yeah, it is. I mean, vast majority of the mortgage advisor industry belongs to the Professional Advisors Association, and their annual awards a few weeks back managed to take out a gong, if you like, and it's always really nice when you get industry recognition for what you do. So I was right pleased with that, Steve. Thank you very much. And that was a video, I think, or a still from a video that we did for the business, and it took a fair bit of persuading from my marketing guys to do it, but I was pretty chuffed. I can tell you that.
Oh, look, you got to celebrate your wins, don't you? As somebody we both know would say. And that's a fairly sizable one. So, what sort of recognition does it give you within the industry? Is it a nice plaque and everybody then?
Pretty much. Yeah, pretty much, mate. You don't get sent on any sort of overseas trip or anything, but I think it's recognition and reward enough. I mean, there's a fair few hundred mortgage advisors out there, and there's plenty of fantastic guys and girls who've won the award in previous years, and I've sat there in the audience and watched them go up and collect something well deserved. And I guess this year it was my turn, and it's always wonderful when your peer and your peers and your industry body recognise what you do, and can't do it without the amazing clients and the amazing team that we've got at the Mortgage Supply Company, mate. And so long may it continue. It's just nice to keep doing good stuff and be recognised for it.
Yeah, absolutely, and it's recognition, I think, too. I mean, Property Tutors has worked with Mortgage Supply Company for, too many years than I'd like to admit now. And we work with you because you do right by our clients. You get them the finance they need. It's the right funding, and you have such a robust back end of your business that it just makes our lives so much easier, and it just ticks one thing off the list that we don't have to worry about. So, you know, I mean, it's a great thing, and yeah, congratulations. I'm really impressed. That's great.
Thank you, mate. Appreciate it. Thank you so much.
So, you are a mortgage supply company. Do you want to explain to the people online tonight, sort of, I don't know, the lift pitch 2-minute version of who Dave Windler is, and go from there?
Yeah, sure, absolutely, no problem. So, yeah, I've been mortgage broking now for about 12 years, and you know, cut my teeth in the industry at the bank in New Zealand as a mobile manager, and it was a big change of career for me, because before that I was on the coaching staff at Auckland Cricket and spent a fair bit of time as director of sport and taught a bit of PE at Sacred Heart College up here in Auckland. So just needed to kind of reinvent myself and do something completely different. But I guess, you know, that prior career stood me in good stead, because I'd like to think that we bring a coaching, training element to what we try and do with our clients, and, you know, lift it out of just being a transaction and being somewhat of a journey where we empower our clients to understand their mortgages, to understand what they're doing, and hopefully make them self-sufficient, really, by passing on the benefit of our knowledge, just like any good educator should do. So we've got our main office up here in Auckland. We've got a really strong presence through Carl Mann down there in Wellington. And yeah, growing. We've got another office just opened up in Manukau and Hobsonville. So we've got a nice bit of growth going on, and a really, you know, strong, high quality advisor team that tends to specialise in the mortgage space. We kind of don't do much in terms of the insurances and all the bits and pieces that, you know, some advisors will do. We refer that. We try and stick to our knitting, and we run with the mortgage speciality, and particularly working with property investors. I think that's probably what we're good at.
Magic. And realistically, why is it you deal with or work quite closely with property tutors and support sort of, you know, the coaching side of this business so strongly? What brought you to that?
Well, I think that I'll touch on it in one of my slides shortly. I think there's a really big correlation between the job that we can do and the ability of our clients to buy smartly. So the smarter someone buys, the greater the activity that they have and the quality of that activity, the more we can do for them. So there's this real connection between the two things, which means that if those clients are coached and supported and mentored, then they're more likely to make smarter moves, and that brings us to the fore in an ability to keep them moving forward and get some momentum. So that's why we've enjoyed the relationship, because of that connection between smart acquisition and smart lending.
Yeah.
And
okay,
I think,
great.
With that slide you've just popped up there, Steve, I think it's very easy for us to talk about a mortgage as a transaction, but it's more than that. It's what you do with it. And I think our role is to keep our clients moving. So often we're talking to people whose banks said no. We work pathways that say yes. Make what we do fit the client's goals and objectives and what they want to do. So we're really good listeners, help clients on that journey. And even if someone's not in a situation where they're looking to buy or, move forward, is sometimes we go in there and just tidying things up. We just improve structure that they've got, get them a better deal, and our advice comes for free. The only time that we're charging clients is when potentially they're trading, potentially when the mortgage is short-lived, or commercial or big development deals. But ordinary residential investor lending, where we're dealing in the long haul, we get paid a commission for our services, and therefore our advice is free. So we're not on the clock, and we're not going to send our clients an invoice for that sort of work. So there's no obligation to touch base with us and have a review of where people can go. We do that. We give up our time for free, and in the hope that we get to do business with people.
Yeah. Fantastic. Cool. So realistically, the mortgage supply company is set up really nicely to be able to actually give, not just supply mortgages, which is in the title obviously, but also to give advice on
Yep.
the right funding, each investment, so that, and you said it, continuity of people's property businesses is really quite important. So, you know, what I see quite a lot is people go to other brokerage firms or go directly to a bank, which is sometimes the worst thing they can do, and they get the mortgage, don't get me wrong, but there's no prior thought, there's no consideration of the next deal after this or the next deal after that, which I think has probably hamstrung a lot of people with, you know, loan-to-value ratio restrictions in particular.
Absolutely.
And,
look, I think it's a really strong point, Steve, because, you know, I think, you know, with what we try and do, it's almost like a little game of chess, in that, you know, you want to try and think 2 or 3 moves ahead. You know, we certainly want to encourage our clients to do that with their property acquisition. You know, they might come across a good deal, want to do it, but then find that purchase then roadblocks them. And they could do it, they can buy it, we can fund it, but it's like, well, what do you do after that? So it's constantly looking for those situations where our clients purchase things that will add sufficient value for them to keep going. And when we're looking to fund that purchase, we're trying to think, what does the next step look like, and will the lender that we're lining up to settle with, to take possession of this new purchase, are they going to help us on the next one and the one after that? And try and look, you know, past our nose. Really important, really important. And I think, you know, what we're trying to do here is, you know, take our clients through, you know, a bit of a journey, really. And I mean, I've got clients I've been dealing with now for 10 years, and I think that, you know, gosh, I mean, there won't be anyone on this webinar tonight who are down at the bottom of that staircase in the I won't category. They're not here tonight. There might be many of you who think you can't, and you know, I think a big part of our role is to assess people's situations and, you know, try and give them some encouragement, some advice, bring them, you know, through to I can, show people that they've got the ability to move forward and reach the goals that they have. We facilitate that, we're enablers, and hopefully, you know, take that people on the road to, you know, getting to the top of the ladder and success in whatever that means for them, because it will be different for different people. And, you know, we always look to get to understand, you know, what is that measure of success, so that we can help people take that journey and then hit the mark.
yeah, absolutely. It's the way, that's the trick, isn't it?
Yeah, absolutely. Yeah, very much so. And I think, you know, you touched on a few of these points a little earlier. And look, I'd be really interested for the people listening to sort of make some comments at this stage. You know, you suggested quite rightly that growth has slowed in Auckland, and I'd love to know what's going on around the country. I mean, what's happening for you in Wellington at the moment, Steve?
Well, Wellington's become a really interesting market. I spoke to 2 of the top real estate agents in Wellington today, John Ross, who actually owns Professionals Real Estate in Lower Hutt, and Adam Coburn, who's actually with Low & Co in central Wellington. And I was just talking about other stuff with both of them, but sort of came back to, you know, knowing I was going to be on this webinar tonight and just kicking around where the market's kind of sitting. And, you know, Professionals Lower Hutt has 47% market share last month of all sales in the Lower Hutt area. And so they've got a fairly good handle on it. And Low & Co is one of the biggest companies in central Wellington as well. And the overriding commentary that they're telling me at the moment is basically that Wellington actually had a little boom in the last 4 or 5, 6 months, and it really lifted nicely. Values have come up really nicely, rents are really good. We don't have anywhere near an oversupply. And what's happened is people have sort of, because the market's moved upward, people get kind of greedy, right? And they stop selling properties because they figure, if I sell it for $500,000 now, in 12 months' time, it might be worth $600,000. So they just hold on to them, which creates another little bubble, if you like, and it pushes values even harder. And what's happening is, and I heard this very recently from, Dave, you'll know Joy Thompson, who works for me. She's got a project on out in Pauparumu, and her valuer said, look, you know, realistically, I should be able to value it at this point, but I actually had to pull the valuation down slightly because there's no comparables around that I can point to, because there's just nothing on the market. And I'm hearing this from agents as well. So historically low numbers of listings on the market, and there's just not enough stuff tripping through. But what everybody's also telling me is that when stuff does sell, half decent quality properties, anything that's really not a complete horrible property, it's getting record sale numbers in Wellington, which is very different from Auckland.
Yeah. Look, I think you're right there, but I think when you've got a tighter environment in any industry, any sector, there tends to be a flight to quality. So
yes.
What I mean by that is what I'm seeing is that properties that are of quality, they don't have any issues, they're nice and clean and tidy, well presented, they're selling, and they're selling at a good price. But something that's got something unconsented, or it's there's not, the people are turning away from them because the buyers have got choice. Although there's limited stock, there are also very few buyers in market at the moment, so they're swaying towards the quality stock, and they're avoiding anything that's short of the mark there. And what we're finding within our business with our investor clients is that there's a fair number of them who, over the last 12 months, have stayed fairly quiet, and now they're starting to come back and inquire of us where they stand from a borrowing capacity perspective, because they're looking now to get into market because they see opportunity. Prices have come off the peak. Prices have come off the peak, and they're looking at opportunity.
Yeah, because from where I sit, right, I work with clients who are finance approved, want to buy a house in the next couple of weeks, and they're out there in the marketplace. And so I'm actually at the coalface, whereas you're actually a step before that. And I find this really interesting. And I'm talking to Carl Mann, who's Mortgage Supply Company's rep here in Wellington recently, and he was saying exactly the same thing. Whereas at the beginning of the last boom, mortgage brokers got incredibly busy but didn't earn any money, because what they were doing is doing pre-approvals for every man and his dog, and then they would go out there and start looking at real estate. And I can see that starting to happen now. The pre-approvals are starting to come through the system, and those people haven't actually gone out and bought anything yet because there's just nothing on the market. And I've just got a comment here from Andrew who said, yeah, absolutely right, Steve. People hold properties in a booming market because it's the fear of greed. It's the fear of missing out. And, absolutely get that. And I think you guys are the precursor to it. You see it before everybody else.
Yeah, very much so. And I think, the biggest thing that for me that's going on right now is that, I think we can all agree that the two key factors are supply and demand. Now, I would look at it and go, actually, you know what, there is really strong demand and a shortage of supply. But the problem that we have is that the demand that exists can't access the funding that they want. And I think as soon as that changes, I think it'll be all on for young and old. And I think, for folk listening to tonight, I think they've really got to think about whether they want to, be sitting on the sidelines, watching the game, or whether they really want to be, tapping the coach on the shoulder and say, let me on, let me on. Because as soon as the LVR rules loosen in any way, there'll start to be significant shifts in the marketplace. It makes sense to me that first home buyers get cut some slack first. I think the Reserve Bank will be very careful when and how quickly they loosen the purse strings for investors. But I think the debt to income ratio fear has subsided. I don't see that coming in the mix. I don't think that it is necessary. And therefore, if we think that we're at the bottom of the credit tightening cycle, if we think that that's the case, then potentially it can only go in one direction, that's to ease, at which point that demand will get into market, and then all you're doing is swimming with the rest of the fish.
Yeah, I mean, I got asked the other day, what are you going to do in the next 6 months? And my answer was exactly what I've done for the last 10 years in Wellington, which is trade property and look out for great deals. And the only thing that I'm going to do that's different to that is we're absolutely at the bottom of a cycle in the Auckland property market. The Auckland property market never stays down very long. And the only other thing I'm going to do is I'm going to go and look for some quality properties that I can buy in Auckland for myself in my whole portfolio. So what are the jitters? What are the scary things that you're seeing borrowers face? I mean, obviously we've got an election coming up, and I don't know if all of the listeners online tonight know this, but straight after the election, we actually have a government, either the old one or a new one, and it kind of just goes straight back to normal, doesn't it? Is there any real scariness there? Both the red and the blue team are basically saying similar things in regards to property, apart from what Labor's talking about capital gains taxes.
Yeah, and I think, I mean, gosh, without revealing which political colour I'd pin to my masthead, I think trying to listen to both sides of the argument that, you could look at it and go, potentially for investors, a national government will deliver, pretty much what they have done historically, with some changes and improvements to first home buyers. I think, doubling the first home buyers grant is a smart move. I do think that needs to be done in conjunction with a lift in the price band. So 650k in Auckland. I think probably if they're going to double the home buyers grant, they probably need to lift that up and put a 7 in front of it to make it realistic. And I think obviously for investors, there's going to be a huge amount of wariness around a variety of tax commentaries that have come out from Labor. And I think the biggest thing for me observing is that there's nothing deliberate, nothing of real policy intent that has been stated aside from, we're going to put together a working group and these are the things we're going to be looking at. I think as a voter, I'd like to know what it looks like up front before I put a piece of paper in a box, and I think that's where my concerns lie. But I think before government starts to influence these things, then I think borrowers need to look at where the banks are at. I think that right here, right now, has more influence on outcomes for borrowers. And you've got a pretty tight credit environment, which is being applied in varying degrees by each of the banks differently. I would imagine there are more potential loan applications being declined, more people listening maybe tonight whose banks said no. We're just finding it hard, but we're still getting yeses because we'll chop and change our pathway and direction to make it happen. We've just got a few more tools in our kit bag. But I think as you said earlier, our interest rate environment is pretty damn good. I mean, I was just looking at this, yesterday, putting the slides together, and we've kind of come back a bit from 6-7 months ago. You take a look at the 2-year rate as an example, which is tends to be one of the more common options taken, and there's actually quite a bit of competition between providers at the moment in that 1 and 2 year fixed rate space. I think within the last week, 4 or 5 banks shifted their offering down. That 435 was an exceptionally good rate. It was issued by a bank who were looking to retain a customer. They threw a particularly hot rate at them. We're finding at the moment sort of 4.49, 4.59 is common and very, very achievable. So it makes for reasonably good cash flow. There's a bit of value coming on that 3-year rate now at 475 from a few providers too. So there's not much of a gap between 2 and 3 if you think of a card in a competitive rate being sort of 449, 459, that 475, which we're getting quite a lot of, is actually quite attractive as well.
Yeah, and I just got to say, I lived through sort of the 8, 9, 10 years ago market that property investors were in, and we were paying 9 and 10% with great capital growth. I just look at this and go, the difference between 4.25 and 4.75 is just absolutely nothing. It really isn't.
Yep.
And all of these interest rates are an absolute gift. So my question, I suppose, is, well, how hard is it to get main bank funding at the moment? I mean, you're at that exact same coalface. Are people getting turned down? How hard is it?
Yeah, look, it is tough. I mean, I think, it's what we do every hour of every working day across, a 20-strong advisor team. But we put more time and effort into, collaborating with each other internally to find out where the solutions are at. So as a team, we're constantly meeting as a group. We're workshopping files to try and work ways of best practice in a tough environment. I mean, we're finding though that because it's difficult, we're getting a huge amount of inquiry. Because when things get tougher, people want help, and that's what we're built for. But good borrowers are still getting funding. The numbers have just got to work. So what's harder to do right now is when the numbers are a bit tighter, when the circumstances are a little bit in let's say, the grey space. The stuff that the bank should look at with some common sense and do, they're choosing not to do it. They're kind of opting out. And that's because they've got a shortage of capital, a shortage of funding. They're only going to fund the real good stuff. They're prioritizing what they do, but it's different from bank to bank. I mean, the biggest thing, and I'll talk about it a little bit more shortly, the biggest difference between the banks is how they work out your capacity to borrow through your income. Income is king. You've got to show a really clear surplus on a monthly basis, and if it's marginal, they're the deals that are extremely difficult to get across the line. But we're getting some good wins, and certainly we've got options outside of the banks that can fit in the mix as well. And once again, just allowing our clients to move forward, and that's really what we're all about. All right, let's talk about a couple of, hopefully a few things that folk listening can take away from their time on the webinar tonight. So this is what I see as a pretty typical situation. You might call it the property ladder, I call it the property staircase, where in essence, on one axis you've got action and acquisition, and on the other axis you've got time. And that, you tend to have this situation where property will increase over time, income will increase over time, and as asset values increase, you can leverage, and when you've got leverage and income together, then you can make another purchase. And people go on this pretty steady journey of acquisition over time. What we try and do is we try and shift that and allow things to happen in a slightly different way. If you could hit the next slide for me, Steve, please.
Sure.
So we operate under some pretty critical and key principles, and I think folk listening tonight need to really take home, particularly this first one, which is around split banking. So split banking means that as soon as you have more than one property under ownership, you really need to be using more than one lender. And typically for folk, their first property will be their home, the second property will be their first residential investment property. They go to the bank, bank gives them the mortgage, and as soon as people do that, the bank will link those two securities together. And if you keep acquiring more property, they'll keep linking the properties together with what we call cross guarantees. Now, what that starts to mean is that your assets that have mortgages on them are all with the same provider, and they're connected to each other. So as soon as you want to move, you've only got one place to go and ask, and that's your one and only bank. As soon as you sell something, you're going to need permission from that bank to sell down. It can cause problems when your bank at that time is short of appetite, their numbers don't work for you, and it just starts to become difficult to unravel. And certainly one of the things that we really try and do for our property investor clients is deal with multiple providers across multiple securities and give them some flexibility. For leverage, we understand, that it's making use of equity that we have. I think that if that's the hardest thing right now with a doubling of the requirements of deposit. We need 40% on a residential investment property. If we're working with a bank, it's double what we used to have to come up with. So certainly with leverage, we've got to concentrate on those workarounds, because it doesn't matter how much income we have, we're not borrowing unless we can leverage, unless you're fortunate enough to have a wad of cash in the bank. I think it's really critical for momentum that anyone who makes a step forward their next acquisition, going back to that kind of game of chess thing where, we want to try and think 2 or 3 moves ahead. You want to try and see where the leverage is for whatever it is you buy. So you're not buying the stuff that's already been renovated. You're buying stuff that you can renovate, that you can add value to, so that you can shift the numbers and create equity in whatever it is you buy, whether it's a do-up, whether it's a minor dwelling, whether it's a subdivision, whatever the spin is, to create further leverage going forwards, for me, is absolutely critical for those of you that want to progress up the property staircase. And then none of this stuff happens. You can't leverage unless you've got the income component correct and you're dealing with the right bank. As I said previously, all the banks measure income differently. You can go into your bank, no matter which bank it is, they could say no purely based on how they calculate your ability to borrow through income. There could be 6 other providers who might say yes. And you just, this is where we know the numbers across all of the providers, and we can make our solutions fit. And sometimes, the serviceability piece might take us past and out of the bank environment into a non-bank environment, and that's okay. If it allows us to move forward, if the cash flow is not overly affected by potentially different rates, then we'll take it. We make a judgmental decision on whether we move forward with the acquisition when we're using non-bank lenders, because if that's what it takes for us to buy, that's what we can look to do. And then we're fitting these things in with our client strategies, whether they're holding or trading or a combination of both. We'll look to try and make these principles work for them, and hopefully, we can move forward through to escalating their situation. If you could pop the next slide up for me, mate. So we're looking to try and squeeze time to allow greater action and greater acquisition. And this is where we work well with, particularly your clients, Steve, and good investor clients, because anytime someone buys well, whether it's a great location or the price is good or it's got potential for forward leverage, it gives us something extra to work with, because if the numbers stay the same, we will always come up with the same results. And we really encourage our clients to try and work with us to shift the numbers. You buy well and you add value. We get some, we just got to. This is where a collaboration between investor and mortgage advisor, I think, is really important.
I think from our end, Dave, what we see quite often is investors, they stumble on the first couple of properties and they get it right on the next few, and they roll through. And I've got a lot of ex-clients now and current clients who are sort of at the point where their whole portfolio has 15 or 20 properties in it that they've collected over the last 7 or 8 or 9 or 10 years. And particularly in the Auckland market, that makes you incredibly wealthy these days. And sometimes they're what we refer to as equity drunk. And they start only buying for equity, and we've got to say, well, look, you've got to put some more cash flow into this, because the bank's going to look at your ability to borrow shortly. But also, with 10 or 15 properties, you can basically go, geez, I actually need some more money to go and buy this house. What haven't I revalued lately? And you'll be really surprised at what it's worth. It starts moving.
Yeah, I think the thing with that as well is understanding how, in many different ways, a property can be valued. The registered valuer is not the sole source of a number. These days, banks will use e-valuers, the CoreLogic online valuation, cost you 40 odd bucks to get one. And sometimes the e-valuer will come in low, but actually, sometimes it will come in high. We've had plenty of situations where an e-valuer has come in higher than the client anticipated it would, and all of a sudden, it's unlocked equity we thought we didn't have, just because we took a little bit of extra care to measure the value of a property or two in a slightly different way. And I think just the last point on the slide is for those that, potentially at the beginning of their investment journey, is the property down at the bottom of that escalator, which is your home. Don't ignore your home as an investment vehicle. Right now you can leverage better against your home than any other property that you might own. So make use of it. Once again, buy well, add value. We can go to 80%. and it tends to be a higher value property than what you then go and purchase as an investment property. So it's where leverage works best. And so, you know, apply some of our investor rules to your home and see what you can do to shift the numbers, because you'll get better extraction of leverage from your home compared to anything that you might own in your rental portfolio.
Yeah, absolutely.
Some key points from me. I'm just going to try and give folk a few takeaways here. And I think, you know, first thing first is, you know, you've got to actually look at to where can you create equity. As we've just touched on, you know, measure the security value differently. Don't always default to a registered valuation. You know, what's the E-value would look like? Can you shift the numbers? You know, can you add some value just by renovating, subdividing, building a minor? Are there things that you can do here that shift the numbers? That enables you to consider some leverage in order to make the next acquisition. And you know, certainly if you've got strong income, one of the options that's well within your control is to have a loan structure that allows you to pay down debt, particularly over your home. I mean, it takes longer, but it's within your control to do that when you've got the income to do it. So why wouldn't you take a look at your loan structures over your home, because everything you pay back leaves leverage to take out later for investment property purchases in the future. And then once we've shifted the numbers and made sure that there's, you know, enough there to extract so that we can go buy again in the marketplace that we want to operate in, we've got to extract it out with the right lender. And that's very critical at the moment when you've got banks who ordinarily are not that keen on giving people revolving credit facilities, which is one of our favorite tools. We've actually got to pick the right lenders to get that equity out with, and we've got some, you know, really good solid pathways that we follow there. So, you know, point number one, create some equity. You've got to shift your numbers, and don't be a lazy property owner. You know, take a look at it, see what you've got, and see what you can do with it. Once we've got that leverage piece, then, you know, income becomes the key factor. So, you know, we can look at a portfolio, look at a few properties, work out that there's plenty of leverage going on, but we don't get to get that equity out unless we can prove that we've got the income to get it out. And this is where banks have tightened up most of all. Outside of the, you know, any shortage of capital that they might have, or you know, difficulty of funding, you know, for at least a year or so now, they've been operating progressively more thoroughly under what we call the responsible lending code, which means that the bank's got to facilitate debt for borrowers in a responsible manner. And there's been all sorts of shifts in how they do that, but here's some key factors. So, you know, straight off the cuff, you know, credit cards have 3% monthly expenses. Now, what I mean there is 3% of their limit. So, you know, you have a 10 grand credit card. The bank makes an assumption that you can spend 10 grand on that credit card in any given month, and therefore, if you have to pay it back, it's going to be $300 a month straight into your monthly expenses. So we used to have an ability to what we call mitigate that. We would show that the customer paid it off in full every month, and therefore there's no need to put that $300 in because, well, customer pays it off every month. But right now, there's only one bank that actually still does that, and the rest of them will put that limit in come what may. Second thing is with that is that there's been a big shift for banks to move away from what they would call bank minimum living expenses. So every bank would have a different calculation for what a typical individual or couple or kids might cost a household, and they're now actually looking at bank statements really thoroughly and using customer stated expenses. So if you've got a high spending pattern, it can impact on your ability to borrow. Second point really is, or third point, sorry, is really for our self-employed listeners. And, you know, there's a real direct correlation between what your accountant's going to try and do for you and what we need to have happen. Banks will lend to self-employed clients on the back of their taxable income. So whatever's on your bottom line is what the banks in general will use to measure your capacity to borrow. So if we have a situation where that's being kept to a minimum to, you know, work through sort of tax complications or whatever you'd like to call them. Seriously, if you want to borrow some money and you're self-employed, pay some tax. Be tidy with your affairs, overdrawn accounts and, just having unarranged overdraft fees and all of those sorts of things. Don't do anything for the look. Keep everything tidy. Make sure that your affairs are kept in good order, because you don't want a situation where the numbers work, but you've got an untidy kind of state of affairs, and the bank goes, actually, we don't want to do this because the customer obviously can't afford what they've currently got, so we're not going to give them anything further. And I think, as I've sort of mentioned a couple of times, the biggest difference is every bank will use a different calculator, and we can plug in, a set of numbers for anyone listening tonight, and each of the banks will come up with a different outcome, and that's the biggest difference between the bank providers that are out there. So make use of your income. It's really, really important. If you just pop on to the next slide for me, Steve, that'd be great. Look, people are sometimes pretty non-bank lender averse. I think, in marketplace at the moment, we've got a couple of what I would prefer to call near-bank lenders that can do a job, and then the way where they can do a job for our investor clients is their ability to go beyond the 60% LVR rule. Liberty Finance can do 70%. As long as it's the right property, right sort of client profile, they're happy to go to 70. And if you really needed to, they're happy to go in, have a second go in behind and leverage it up to 80. So if someone's only got enough equity in what they've currently got to provide a 20% deposit, we can work with that. One of my preferred options, and one that we're exercising in the right circumstances pretty regularly, is working with Resimac. So Resimac is a near-bank lender, can do 80% on a rental property as long as they've got the owner-occupied home. So we can put up with hooking a home and a rental together to get the leverage if it's what it takes for us to move forward. So they can go 80 on the home, 80 on a rental. In fact, they can go 80 on another rental and another one. And the rates are good. 4.94 is a pretty reasonable market rate. If that's what it takes to get that next acquisition and keep moving, some of these non-bank lenders are fit for purpose, and certainly, a pretty important part of our toolkit.
Yeah, that's really important. I mean, second-tier lenders in the last boom in the property market were at sort of 7.5% for first tier and 9% for second tier. So to have a second tier at under 5% is still so cheap. It's just about free money.
Yeah, it is, mate. I think the biggest difference with our non-bank sector now, as opposed to in and around 2008, is that our non-bank environment operates under the same responsible lending code as our banks do. So the checks and measures and balances that are in place there for these lenders are pretty firm, and certainly trying to get lending done with Resimac as an example is as hard as it is putting together a bank application. So you run the gambit, your numbers are scrutinised just like you would applying with a bank. The biggest difference being, though, the outcome you get is one of much better leverage and the ability to make that next purchase happen. And if we haven't got enough equity in properties to go with a bank solution, we'll look to these options quite readily. Make sure our clients understand what they look like, what they price like, and make sure they understand what the solution will do for them. And if that works, then we go ahead and do it. We're doing quite a bit of lending with these guys at the moment.
Yeah, and then obviously you've also got other lenders outside of this that you sort of, I don't know, are harder to explain, and therefore you usually come along to our events in Wellington and sort of give a description of how they work, and that's another level on from this.
Yeah, look, I mean, the two lenders I've sort of touched on there, as I say, what I call near bank lenders. We have a number of lender partners that are very useful, particularly when our clients are trading. So, one of the workarounds for my mind of the in LVR rules at the moment is, if you have to leverage 40% deposit and it's too much for your portfolio to handle, then certainly some of my clients, and certainly I guess some of yours, Steve, are looking to trading to generate cash. So instead of having to borrow through leverage, they will buy, renovate, sell, drop some profitability out of that transaction, and they're looking to do that enough times that they can come up basically with a cash deposit through their other property activity. And we've got some good lenders that support that. They're what we call asset lenders, because they are really just lending against the security to a certain LVR. It's short-term funding because they know that the borrower's in, renovating, sell, out, and turning things over. And we'll go into much more detail around those sort of providers in Wellington towards the end of October, which I'm looking forward to.
Yeah. I think that's the biggest question a lot of people online tonight might have, is that you've got an environment where you want to be able to go and buy 3 or 4 houses and have a few of them rolling out all the same time. You want to renovate a couple and keep them. You want to renovate a couple and sell them for cash flow. And most people then go to the bank and they say, hey, can I borrow $900, $1 million, $1.5 million? And the bank goes, well, no. And then they look at our clients, and under your management of the funding and under my management of what they should buy and how they should do it, we manage it, and we manage to get those numbers and those sorts of things to actually work. And I think that's the key point that a lot of people don't get, is that we have access to and can put our clients into funding and deals that just aren't available on the open market. They just can't get them through their normal banking relationship or their normal mortgage broker. And they are a little bit more complicated. They do take a little bit more explanation, and which is why we take a full day at our events and spend so much time.
Yeah, very much. I mean, certainly it's a style of funding that banks don't overly like doing. They want to give somebody a 30-year mortgage so they can make 30 years worth of profit. If you go in there and say, I'm going to buy a house, renovate it, sell it, I should be done within about 3 months. Can you give me a mortgage? I'll go, actually, probably not. Purely because it's the sort of business that they don't make much money out of, if anything. And it's particularly so when we've got a shortage of capital from our banks. So they're not going to give their capital base out to people on a very short-term basis. They're far better off putting that money somewhere else, and that's definitely what they're doing. So, historically, we would have done a bit of trade funding with our banks, but it's pretty tough. So, look, I mean, I think for us, what we try and do is work around roadblocks for people, and typically, you'll have a situation, as we've just discussed earlier, in the home and the rentals with the same bank. That's a roadblock. We've got to get them separated and start working with multiple providers when we've got multiple properties. Current bank says, no, you've got heaps of equity there, but they won't give you the equity out. Typically, that's because of income. The income math isn't working. So once again, we've got to find a bank that whose income math is different. Sometimes it's, there's a real obligation for banks, and I think quite rightly, to understand why you want to do what you want to do, or what's the purpose of the lending that you're asking us for. And we're just pretty good at telling the story. So we will tell the story to fit the circumstances and fit the numbers. We try and deal with pathways that understand what it is we're trying to do, particularly for our property trading clients. That's really important. And in fact, for any of our investor clients, the key step is getting a revolving credit facility out of any equity that might be available in properties. And once again, when we hit the end of October, Steve, I'll be going into a little bit more detail on the use of revolving credit facilities and how to get them out. And because it's the best thing that we can do for anybody who's wanting to move forward with their property investment, is extract that equity out with revolving credit facilities. It's a critical tool.
Yep.
And I think, once again, as we look to review a client situation, that we can measure where the equity might be, and whatever that is in dollar terms will equate to, let's say, 40% of something. And if that 40% isn't enough, then sometimes our clients have got to change the target. It's all relevant to where they might want to buy. The biggest problem, obviously, in Auckland over recent times since the LVR rules came in is the target's a pretty high one. You want to buy a 700K property, well, you're going to need 280K deposit. And you're going to have that in equity somewhere. And sometimes, our clients have, in terms of changing target, then started to look at, well, actually, how's Tauranga looking, how's Hamilton looking, and how's Wellington looking? So, if you haven't got 280K of available equity, sometimes you've got to shift the target and look to a different marketplace where that leverage can be used to make an acquisition. Sometimes we're looking to shift the numbers. We talked a little earlier around, valuing properties in certain ways, in different ways, and looking at them from different angles to try and see if we can shift the numbers. And sometimes we just got to change our bank or even go non-bank in order to shift the numbers around and make them work for what we want to do. And yeah, can we help you? I mean, we just email me, guys, if anyone's online and just wants us to take a look at the numbers for them. We'll analyze what you've got, give you some indication of where you might be able to go, changes that you could make with providers that you currently sit with, and just give you some advice and guidance, and we'll do that under no obligation at all, and hopefully can help you put together a lending strategy that supports your investment strategy. That's where the two things, as we've said earlier, they fit in well together, and hopefully you can you're in that situation where you're going from I will to I can, and we can help you move forward.
Hey, one thing I've been getting a couple of questions on here, Dave, is
Sure.
When you transfer some lending from one first-tier lender to another first-tier lender, are you seeing a lot of people getting cash incentives to move across banks at the moment?
Yeah, pretty much. Not as a little bit like the Auckland property market, Steve. It's probably got off its peak of 12 months ago or 6 months ago.
Yeah.
But we're getting enough to get the job done. So if you look at cash incentives historically, I looked at them and gone, actually, that's above and beyond what the client needs. Nice to have, but what we're finding at the moment is the cash incentives, for any reasonable sort of loan amount are certainly enough to cover what it might cost you to change bank. And we're talking obviously any conveyancing costs to refinance, and they should be a little bit of loose change. So they haven't disappeared at all. They're just a little bit less than they used to be, and we would be getting them on a regular basis.
Yeah. And they seem to come down to the strength of the borrower as well, how much the bank actually wants them as a client.
Yeah, very much so. Banks will price on a case-by-case basis, relevant to the strength of the borrower. Whether it's one of the big things at the moment, Steve, that you might find interesting is there are a number of banks who are pricing differently based on the security type. There's certainly 3 or 4 of them that are putting, let's say, the margin on property investor funding. So if they're lending to somebody over a rental property as opposed to their home, then they're pricing that accordingly. So you will generally get better pricing over your home than you will on a rental property, unless you're dealing with certain providers. And certainly the New Zealand banks don't overly make that differentiation.
Yeah. Yeah, I mean, there's a bit of a joke going around at the moment that, there's a tree falls down in a forest in the middle of Canada, and it was probably a property investor in Auckland's fault. We absolutely become bully boy for every problem in the world, don't we?
Pretty much. Wouldn't
The one
disagree with that.
there's an article in the Herald last week about Lord buying a house in Auckland. And basically the title of the article said that she was part of the problem. And I'm thinking,
how dare she try and get ahead, hey?
well, not a, it's like, how dare somebody who lives in New Zealand, as a New Zealander, buy a house in New Zealand to live in? I'm thinking, how ridiculous is that? That's just crazy. We beat up. We get blamed for everything, right? But, you know, what do you do?
Yeah. Don't get me started on the journalistic content of the New Zealand Herald, Steve. It's one of my favourite topics there.
Yes, I know. I follow you on Facebook. All right. Well, look. Quite obviously, I hope people that are online tonight, they can see that what Property Tutors basically does is it helps people invest in real estate, and we wrap together with the best advisors and the best people with the best content. And we've done this. You and me, Dave, have done this for years. And what I suppose we do, in essence, is show people a path forward that's not a get-rich-quick scheme by any means of the imagination, but it's a faster way to grow wealthy through real estate. And I think everybody online tonight can agree that, you know, real estate is the way ahead for most Kiwis to have a better retirement, have a better life, set themselves up financially. I mean, I've got clients at the moment that are 25, 26 years old. I've got people that I work with who are in their 70s and their 80s and are still investing actively. And what I like to think that we do is that we get a whole pile of people in one room who are massively active in property investing. And they are my current clients, and obviously people like yourself, Dave, who are advisors and people who, you know, feed one portion of the tool belt that we need. And obviously to properly and fully explain exactly how that works, so that I can show you how my clients are buying 200 houses a year and making $30 and $40 and $50,000 profits every 6 weeks out of a house. We need to really sit down and sort of explain it. So we do these bulk events every year, and we've got one coming up obviously in Wellington, which is Sunday the 29th of October. We're at the Intercontinental Hotel in Wellington. Traditionally, the fire marshal tells us we can get 260 people into the room in that event. It's about a month away. It's well, more than a month away actually. We've just started the marketing on this. We've actually got 28 ticket sales already, and they are basically ticket sales from existing clients of ours who've recommended us to other people. Now, bear in mind that I've got clients that I've been working with for 5 or 6 plus years, and so I've got clients that I sit down and help them with their property investing, and they come back year after year and sign up again year after year to work with me. And so they are obviously recommending us to friends of theirs. So we've actually sold 28 double tickets already, which has basically put 60 people in the room straight away. So we've got 200 seats to sell and tickets to sell. Because you guys are on the webinar with us tonight, I can offer you our early bird ticket sale. And so hopefully what we can do then is get you into a ticket, get you to come along to the event on the 29th of October. And not only is it myself and Dave Windler and the group of experts that we work with explaining to you exactly what it is that we're doing to make really great cash flow in property right now, but we also do this, which you've got on the screen at the moment, which is we take a group of some of our best property investors that are doing the greatest deals possible that we have available right now, and we put them on stage and put a microphone in their hand, and they tell you their story and what it is that they're doing in property investment right now. They will tell you the last few deals that they did. They'll give you a really decent idea of the sort of profits they're making. Most people find that incredibly useful just to get their head around it. So here's our early bird deal. Basically, what we're saying is that we've got a pre-allocation of tickets available for the people that are online tonight. All you need to do to grab one of these tickets is to go to oneepicevent.co.nz. That's our ticket sales website. It explains the entire product. I've actually chucked a video up on there to explain a few things to you as well as a sort of a thank you freebie for you guys coming along to this webinar for us this evening. So feel free to go along to oneepicevent.co.nz. And we've got 50 general admission seats available for $37. And there's a special freebie there. You actually get something extra if you buy a $37 ticket tonight. And we've got 20 front of stage VIP tickets for $97. Now, a lot of people ask me, how is the VIP seating any better than the general admission seating? And there's an easy answer to that. You get into the event sooner, you get the best seats at the front of the house, but basically we also give away a lot of free stuff from stage, a lot of free books, a lot of freebies and bits and pieces. And let's face it, we give them to the people that are right in front of the stage. We say, hey, who wants this freebie? And if you're right up front, you're going to get some free stuff out of us. So that can be pretty cool as well. And so if you want to buy a VIP ticket for $97, you need to go to their website right now. We'll hold this deal open for about an hour. Normally in these webinars, we sell 40 or 50 of these tickets, and we run out of our allocation. Normally within 2 or 3 weeks of marketing these events, we've got an absolute chocker full room. If any of you have actually been to one of our events before, hopefully you'll know that they're absolutely full of really decent content. We try and teach you guys an awful lot of stuff in a very short period of time. It's only a one-day event, and we give you a lot of tools that you can go away with and use in the marketplace right now. So once I said again, we've got 50 general seats at $37, and there's a special freebie over on the website if you want to grab that allocation. But we've got 20 VIP front of stage tickets for $97 each, and that's oneepicevent.co.nz. So what I'm going to do now is let you guys jump on to grabbing those tickets, and in the meantime, I'm going to answer some questions because we've had quite a few coming through, and I'm going to hit a few. Martin says, great session, great subjects, great info, thanks very much. Apartment purchases, how does size of the apartment affect the lending? Most banks won't touch anything under 55 or 60 square metres these days. Has to be half decent size.
A bit less than that, mate. We'll be all right with something a little bit. Yeah, look, ASB is the best provider when it comes to square meterages, mate. They'll go with 40 square metres.
Oh, well, that's pretty good. Yeah, I think they've loosened up because they've realised that small apartments are the future for places like Auckland.
Yeah, the bank that shifted most recently is BNZ. They've kind of gone, no, we don't like apartments anymore. They've shifted up to 60 square metres. Westpac will come in at 50, ANZ at 45, and ASB at 40. So when you are looking at apartments, you know, size matters and choice of lender for sure.
Yeah, magic. All right, so since you're still online with us, Dave, what's the story with this LVR rule? What do you think's going to happen? What's your, crystal ball gaze on that?
Oh, I think it's something for the new year. I think first-time buyers will get cut some slack first. It makes sense. They were hit first, and we know at the moment the banks are operating under a 10% speed limit. So they're allowed to lend 10% of whatever they do under 80. They can do above 80, and then I can see the Reserve Bank kind of just stretching that out, going, okay, well here's you can do 15 or you can do 20. So I think there'll still be a gradual loosening of the purse strings there, because in reality the banks are actually operating somewhere between 6 to 8%, because they just don't want to breach the cap and risk their banking license, which is the consequence of breaching the rules. So and then I think there'll be a bit of a sit and see, and the Reserve Bank will make sure that doesn't overly impact on house prices as they loosen the purse strings, and then eventually the property investor will get a sniff of some action.
But realistically, let's face it, if LVR restrictions are relaxed somewhat for us property investors who already have a portfolio, anybody that's been active in the last few years has dropped their loan-to-value ratio within their portfolio from some 80 down towards, if not at or below 60.
Yep.
The government's already sort of thrown the gauntlet and said, hey, we're willing to use these tools and we will in future. So most property investors out there, surely what they're going to do is load up on properties and create another little mini boom.
Yeah, and I think that's that'll be the danger that the Reserve Bank will be well aware of. I mean, I think the upside of being restricted to a 60% LVR for investors that are out there and have a reasonable portfolio is, gee whiz, it's a pretty safe portfolio. But I think any time that a bit of slack's created, that it will be sucked up very, very quickly. And I do think the Reserve Bank will be particularly careful how they unwind these rules, and they'll do it bit by bit, and they'll start with first-time buyers, which will be good for our trader clients, Steve, because I can see that the first segment of the marketplace that will spring into action will be the first-time buyer, particularly if any government comes to power and offers some additional sweeteners or improvements with home start grants, and generally speaking, our trader clients are selling to first-time buyers, so as long as they can buy well, we'll have a ready-made marketplace ready to pick up a freshly renovated property.
Yeah, absolutely. Cool. I've just got a few texts through from the back end of our site there saying that there's quite a few people on the website now grabbing those tickets, and there's been a few come through. So, James, looking forward to seeing you at the event in Wellington on the 29th. And Mark has also got a double ticket there. So that's great. Jump on there. Obviously, I've chucked it up on your screen now. You should be able to see what the website looks like. So that's oneepicevent.co.nz, and that's exactly what it is. It's one big epic day of property investing knowledge. Grab those tickets while they are there, and I will keep bowling through a few questions while we're at it. Here we go. There's a big question. Here we go. Crystal ball gazing. Should Labor form a government? Oh, man. Oh, Dave, help me. I don't want to talk about politics.
I'm not sure if I'm that keen either, Steve, but far away.
You know how to lose your entire audience, or at least, 47.3% of them straight away.
Yeah.
Crystal ball gazing. Should Labor form a government and implement their ring-fencing property losses plan? Do you expect to see... I don't think we have to finish this question. I think we're preaching to the converted here. I think there's a couple hundred people online who are probably not going to vote for Labor. I think they've staunchly and steadfastly put themselves out there on property.
That could get a few keyboards going, Steve.
Yeah, here we go. It's less questions and just more abuse now, really, isn't it?
Yeah.
Moving on. Should I pay a valuer to value all my properties, or does a bank do it now? Well, interesting question. You definitely should get fresh valuations if you haven't valued your properties for, say, 2 or 3 years. Speak to your advisor like Dave first, though, because certain banks do use a system whereby they recommend heavily the valuers that you should use, which is the valuer on a panel-based system. So, speak to your advisor first. Would you agree with that, Dave?
Oh, hugely, Steve. I think the rules around how you go about getting valuations has changed drastically. So the majority of the banks now will run let's say, a valuation ordering system. They're either using CoreLogic's system or the Velocity system. And basically what happens is the valuation request is put into a website portal. That portal will quote you a rate for that valuation, and it will get distributed to a valuer in your area. You will not have any control over who that valuer is, and it goes forward from there. And that can, I don't like it. We lose control. We lose the opportunity to refer through to valuers who can provide our clients with good service. And yeah, I think the first step for me will always be to take a look at e-valuers, because if an e-valuer is good enough to do the job, let's pay $40 for it rather than $700 for a valuation. Yeah,
agreed. Yeah. Yeah, I mean, if you can get it done with that, then, let's go. And I mean, particularly if you're in the Auckland property market, as I said earlier, you've probably got equity in your property if you didn't buy it last week. Wellington's
definitely. Yeah, definitely the first step for us is taking a look at the overall situation and trying to, let's say, forecast which lender are we going to use first, because then we can anticipate the valuation process and go forward from there, rather than go out and get a local valuer to do the job and then find out we can't overly use it.
Yeah, absolutely. Excellent. All right. Just had a couple more ticket sales come through, so there's a pile more there. It looks like we've gone through about 14 or 15 ticket sales, so that's great. If you've got any more questions, bang them out. I don't know how much longer our friend Mr. Windler is going to be able to hang out with us, because he's a very busy man. This is not your first speaking arrangement of the evening, is it?
No, I've just done a seminar just before I hopped on here, but I'd say about 180, 200 people, and probably fairly shortly need to pop back there and see if anyone's missed me.
Awesome. All right. Well, we'll let you go there, Dave, and we'll rip into this. I'll back one of these questions. Once again, really appreciate your attendance, and thanks for bringing us some real fresh information as always. and enjoy the
Always
rest
a
of
pleasure,
your...
mate.
Thanks, Dave.
Yeah, thanks, Steve. Well, all the best. Thanks a lot. Cheers.
Magic. All right, so awesome. Thanks very much, everybody, for that. Look, we are banging through the questions, we are banging through the content, and we've got a few tickets still sitting there. So if you need to get your hands on one of our tickets for our Wellington event on the 29th of October, bang into that website and have a good read through. There's a lot of decent content and interesting information, answering a few questions for a little bit longer. I got a question here from Mark. It says, does the 20% loan-to-value ratio rule for new builds apply to new build apartments? Yes, absolutely it does. It applies to new build houses, apartments, and anything off the plan as well, which can be really valuable, can be well worth looking at if you have a great deal in front of you or limited equity to get stuck into it. I've got a question from Jimmy asking if he can have a copy of the PowerPoint notes. Unfortunately, no, we can't send out the PowerPoint, but what we will do is we will email out to everybody a copy of the recording of this event, and if you want to look back over it, you'll be able to just zap through it on YouTube. The next question I got from Dave was, why split loans to different lenders? The reason for that is that a lot of people get stuck with a one lender trap, which essentially means that they have their own home and most of their investment portfolio all with one bank, which legitimately over a period of time gives that one bank too much control and too much power over you as a borrower and your portfolio. So it's very, very important to split them into multiple different banks so you can go to different banks with different things. Mark asks, how do you feel about regional property markets, in particular Whangarei? I've famously never been a really huge fan of regional property markets. If I was going to move outside of Christchurch, Wellington and Auckland, I would basically be looking at Hamilton and Tauranga. I'm not personally a big fan. I think that property investors function on cash flow, but what we really, really need to become wealthy as property investors is capital gain. So, I mean, that's one of the most important things. And I think mostly we get that in a good market in the main centres, but also it's actually not all that difficult to at some point become rather wealthy through investment properties. What's the hard part is keeping that wealth and retaining it through a generation. And the trick to that is, if you want to sell, then sell in an up market. The biggest problem is what most people do is that something attacks them from left field and they have to sell in a down market. There's a divorce, or there's a financial problem, or there's a maintenance issue which creates a reason why somebody has to sell. And if that happens, I would much rather be selling in a market like Auckland than I would in a smaller regional market that might be very depressed at the time. So, you know, there's a reason for that. Question from Hayden. Hi, Steve. Are we going to see an increase of houses on the market if or when the rental standards are lifted? I really can't see it myself, to be fair. The standard that's being lifted is basically improving the lowest 1 or 2% of the rattiest houses in the country. The standard that they're trying to lift it to is actually still very low. So I can't see that a lot of people will need to sell their properties or flood the market or anything like that if that happens. Being asked by Mr. Patel about how do you feel about the Christchurch market. I'm becoming more and more comfortable about the Christchurch market. I think it's become a healthier and healthier marketplace in the last couple of years as the rebuild continues down there and as things go back to a level of normal. I'm more buoyant about the Christchurch market than I was previously. Just also had a text through that a couple more ticket sales have come through. That's awesome. Well, listen, guys, I hope that's been really useful to you tonight. I hope that you get along to our event by jumping on the website and grabbing yourself a ticket at oneepicevent.co.nz. If you're still online and you've been trying to get on that website and been blocked or haven't been able to manage it, just message me on the questions section there, and I will make sure that we get your ticket organised for you in the last allocation of pre-sale tickets. Other than that, it's been great having a chat to you this evening, and jump onto our Facebook fan page, throw it a like, and register for the next event, the Property 101 seminar that we're going to be running in a couple of weeks' time. Other than that, great to hear from you. Thanks very much for joining us this evening, and I wish you good night.